Hello, good evening. So we're going to take a look this evening at Forex trading as a business. And your workshop this evening will be delivered by the Ladder Back Down. And my name is Ibukun Emmanuel Adebayo. I used to trade and comment on the spot market, the Forex market on forexfactory.com. And I stopped commenting in 2016 prior to starting an MBA in finance, and I also stopped trading around 2017 as I prepared for my existing role now. So I'm not a trader, and I must issue this disclaimer as well that the Ladder Back Down is not a Forex broker or a dealer. We actually created the Ladder Back Down and registered this with Companies House, not with the FCA, in January 2020, that is January 2020, because we really desire to see an improvement in the lot of BME individuals. So that is Black and ethnic minority individuals in particular. So we offer with the Ladder Back Down free workshops in different courses, including Forex trading. We are not registered with the FCA or with any other regulator as a broker or a dealer. So the content of these slides is simply for your educational purposes only. And so nothing in these slides should be construed as a recommendation or a solicitation of an offer to buy or sell securities or to purchase any financial instruments, because we are not qualified or registered by any regulator in the UK or abroad to offer financial advice. And some individuals observing or participating in these workshops will never trade. So we advise anyone that attends our workshops to simply review and listen to the contents of the workshops, to also further your education by visiting sites that we will share with you during the course of these workshops, and also buying books, because readers are leaders in any trade. And once you've practiced repeatedly on your demo, if you decide that trading is for you, then you would need to reach that decision on your own and hopefully remember some of the lessons gleaned on our workshops. So Module 1 simply covers an introduction to Forex commodities, futures, Bitcoin and indexes trading. We'll be taking a tour of Metatrader 4, which is one of many trading platforms out there. We'll also be taking a look at how to select a broker and how to avoid scam brokers. So again, we will not recommend or make any recommendations as to which broker you choose to select if you ever choose to go live as a retail trader from the comfort of your own home. We'll also be taking a look at a practice trade. So let's go through this introduction to FX commodities, futures, Bitcoin and indexes trading. Now here's a summary of what happens on the spot market and on your Metatrader. Market prices tend to trend between two price ranges, so between A to B and B to C, until there is positive news that could cause the price to start trending between C to D and D to C. A here on our charts and C here and E and G are referred to as supports. B, D, F, and H are referred to as resistances. And these are simply an indication that we buy when the price is low, when it's reached at a support or when it's at a support. And we take profit just before the price reaches a resistance, and then we sell again at a resistance and take profit when a price reaches a support. So trading is simply buying and selling between the trends. Between A and B, we buy from A to B and we sell from B to A. When the price changes its trends, we simply do the same thing again. We buy between C and D and we sell from D to C. We buy at a support and we take profit just before the price hits a resistance, before it starts coming down again. So again, here are some rules. We always buy low at a support and we take profit just below the resistance. We sell high at a resistance and take profit just above the support. If we're buying at a support, and we will talk about this later, to preserve our equity, if we're buying at, say, C, after we've conducted our analysis and we believe that the price is going up, so we make a purchase, we buy at that support at C. To protect our equity in case the price is actually going down, we would place a stop loss just below C, so that in the event we have made a purchase at C, with the understanding and expectation that the price is going up to D, where we're going to take our profit. If we've made that purchase at C and the price starts going down instead, we need to have a stop loss between C and B just to ensure that we minimize our losses and we have equity remaining in our account to enable us to start trading again. We live to trade another day if we use our stop losses consistently. Now, I've pointed out that sometimes a price will reach a historical high or a historical low. And that is usually a good point at which we sell an instrument. A historical high or a historical low is a good point to buy an instrument. But we'll take a look at that as we go further in these workshops. Now let's take a look at the US dollar Swiss franc daily chart between April 2016 and November 2016. Now, here is a support level, a low price that the US dollar Swiss franc reached around April 2016. So April 2016, it reached around here. Then by mid-April 2016, the price reached up here. Then April 2016, we now went down to this support. So we formed a support around here. Then From April 2016 up until around May 2016, we went to this price, which is around 99.59. So for each US dollar, you were paying 99 US cents per Swiss franc. So you were paying 99.5 cents per Swiss franc. So that was as of May 2016, around the 20th of May 2016. By the time we got to 23rd of June 2016, we were down at the same support price or around the same support price that we were in April 2016. So we reached this support. You can see where I've drawn these ticks to show us the support areas. So June 2016, we were down at the same price, which was 95.24 cents to each Swiss franc. So if you took your US dollar to a post office to exchange for a Swiss franc, you would have received for each 95 cents, you would have received 1 Swiss franc. Now, the price reached that 95.24 in April. We had an attempted false breakout down to 94 cents. That is what this long wick is about, but we'll talk about that later as well. So the price reached around 95.24 in April, also reached that point in June, 23rd June. Then in around the 18th of August again, we reached that exact same price. And then around the 4th of November 2016, we had this false breakout. Actually, that would have been around the 7th of November 2016, if my memory serves me well, which was the day of the US election. So if we take a look here, and that was a false breakout on the day of the US election, because we can see that we had this very long wick where the price dropped down to this support, and then it promptly went up on that same day back to continue a trend that it had started from around the 4th of November or so. So again, we'll talk about that later. But we can see here that the price hit the same support level on 4 occasions in 2016. So we've got here support, same support here in August, same support here in November. Where is the main resistance on this chart? Well, we can see that around the 20th of May, this candlestick here, it reached this price. Then we went down to this support. Then we went back up to this resistance, to this main resistance by around the 27th of July. Then we came down to a minor resistance, which is here, 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 and here. Sorry, minor supports, here, here, there, and there. But the long-term trend for this from the 27th of July was to go back down to test this support on the 18th of August, or around the 18th of August. So again, we can see that the price tends to trend between support, resistance, support, resistance, minor resistance here, resistance, minor support, resistance, support again, resistance, support, and then eventually we go up to this resistance again, break it down one last time to test this support, and then up we go, and we finally break this resistance at 99.59, and we finally break that resistance on the US dollar Swiss franc, continuing in November 2016. But that is all the instruments, all the commodities, the futures, the currencies that we will trade on the spot market. That is all they do. That is the price action there for you, between a support and a resistance, until some news occurs to break that trend, and then you suddenly see a break of a resistance that is sustained. So we can see here that there was a brief false breakout above this resistance in October 2016, and that was false because we had this spike up and then it came back down and then went all the way down again. And then we continued to go up after the election, continued to go up after that false breakout on the day of the election, continued to go up, and then we finally broke that resistance that it had tried to break from May, where we tried to break it here, and then tried again in July, tried again here, before we finally broke that resistance and continued upwards towards the next resistance at the end of 2016. So the same concept, the same principle applies across all currencies, commodities, all indexes that you will trade on the spot market. So let's take an introduction here and try to understand what Forex trading is. So Forex trading is the simultaneous purchase of one currency and the sale of another. So let's see whether we've actually ever traded the Forex market ourselves before. And when I finished explaining this, you may find that actually that you've traded the Forex market not on a system, but in real life on many occasions. So have any of us ever been on holiday before? So let's say you've been on holiday from the UK to the US. You may have visited a post office or a bank or an FX exchange bureau to change your pounds for dollars to take on holiday with you to the States. And that is simply what Forex trading is about. You're purchasing one currency, which is the US dollar if you're going on holiday to the States, and you're selling the pound in exchange for the US dollar. The only difference between what a holiday maker is doing in exchanging the pound for the dollar and a retail trader or a Forex trader who is trading on Metatrader, the only difference is that one is trading on their computers or electronic device, whereas the other person, the tourist or the traveler is exchanging cash. So Forex trading is a simultaneous purchase of one currency and the sale of another. Why trade Forex? Well, there's a high liquidity market, so 5 trillion, which is 2 trillion up from when I used to trade, 5 trillion a day is traded on the Forex market. There's 24-hour trading 5 days a week. You pay minimal and proportionate fees per trade. For each trade that you take, you pay a minimal and proportionate fee, which is referred to as the spread. You can trade anywhere on any device. So you can trade on a mobile device, you can trade on your laptop, although we don't recommend at the ladder back down that you actually trade on your mobile phones, because you can easily become addicted to trading. And when you're trading on your mobile phone on the move, you may not necessarily have had the time to plan that trade, to do any analysis or to plan or do any research before you place that trade, which is why we recommend that you actually simply install your trading platform on your laptop, conduct your analysis at the weekend, and plan every trade. We'll speak more about that towards the latter end of these workshops when we're talking about Forex as a business. So you can trade anywhere, but it's not necessarily a good idea. High leverage as well is a concept that is touted as an advantage for Forex traders. And that is the broker credit ratio to your funds. The higher the credit ratio, the more you have available to trade. But the issue though is that as a retail trader, you don't necessarily want to have more credit available to trade. We recommend that you actually grow your account bit by bit, which is why we recommended for this course that you only install Metatrader with $100 of demo funds. And we'll also be recommending during the course of these workshops that when you go live, that you also start with $100. Another advantage of Forex trading is that there is profit potential in a rising or a falling market. So if after your analysis you determine that the pound is going to fall, you can sell currencies where which are which are exchanged for the pound. So for example, the GBP USD, GBP AUD, Australian dollar, GBP Japanese yen, you can actually sell those if the pound is weakening. On the other hand, if the pound is strengthening, you can buy and also make a profit. So there's profit potential in a rising or a falling market when trading Forex or when trading the spot market. And there are plentiful free online resources and we'll be referring us to some, but we do need to be careful when we're taking a look at free online resources, because in some instances, brokers offer those resources and then start trying to persuade us to start trading live, including when we're not yet ready to do so. So a word of warning, please do not feel under any pressure to trade live. You may never go live. You may choose to stay on your demo for 6 months, a year, 5 years. There's absolutely nothing to cause you to go live until you want to go, until you want to do so, if you ever want to do so. So no pressure on yourself, and don't allow yourself to be pressured by any broker or by any free online marketeer, for example. Only go live if you're ready to do so. So where and when does trading take place? So Forex trades are conducted online between global counterparties, and the FX market is an interbank or an over-the-counter international global enterprise. As we've said, trading takes place 24 hours a day, 5 days a week, starting on Sunday night at 2200 hours GMT, that is UK time, 2200 hours GMT in Australia. And the exchange closes on Friday night at 2200 hours GMT in New York. So for 5 days a week from 10 p.m. GMT in Australia, the market opens until Friday night at 10 p.m. GMT in New York. So there's plenty of opportunity for us to make profit. And we don't have to trade, we're not limited to certain currencies or certain commodities if the Australian market is open. So you can trade the GBP, Great British Pound, Great Britain Pound, or the GBP USD, also referred to as cable, or, on Sunday night in Australia, whilst the UK exchange is closed until Monday morning. You can trade any commodity, any instrument, as long as you're trading between 10 o'clock on Sunday night and 10 o'clock Friday night GMT. So who participates in the market? Who are the market players? Well, we've got central banks such as the European Central Bank, the Canadian National Bank, the Fed in the US, the Federal Reserve Bank. We've got the Bank of England, Swiss National Bank. Those are central banks, and they participate in the foreign exchange market. Then we've got commercial banks. So we've got the Barclays, we've got other banks, Lloyds. They also participate in the foreign exchange market because they need to make an interest on our savings, on our mortgage payments. So they participate and they trade all our funds, our pensions as well. They trade those. Then we've got investment banks such as the JP Morgans, Morgan Stanley, and other investment banks, Goldman Sachs. They participate in the foreign exchange market. Then we've got money makers, money managers, and brokers. We've got multinational corporations such as BP, Shell. They also participate in the foreign exchange market. We've got registered dealers who are regulated, and they're registered with regulators, with global regulators. We've got options and futures traders. We've got private investors and wealth managers who manage the wealth of high net worth individuals. Then we've got retail traders, such as you, and when I was trading, me as well. Now, when we say who participates in the market, let's be clear here. Our money, our funds, your $100 or my $100 does not move the market. We're simply seeking to exploit any opportunities that we identify when all the big players are actually trading. So our $100, including when we're trading on the demo market, our $100 doesn't move the market. So if we're buying because the value of the pound is going up, it's not our $100 that is moving the market up, or our $1 per point move, or our 10 cents per point move. That is not what is moving the market. It's what the big players do that we're seeking to leverage when we're placing our trades. So let's take a look at some useful Forex trading terms. What is a bullish market? That is when the sentiment around the instrument that we're trading is positive. So for example, if we're trading a currency pair such as GBP USD or GBP AUD, if the sentiment and the news, the economic news, the political news coming out of the UK is positive, that will make for a bullish market. The value of the pound should rise in a bullish market. With a commodity such as crude oil, for example, if there is war or economic chaos or political chaos in an oil producing country, in a high oil producing country, then the market for oil would be bearish. The price of oil would go down. So when all the news is negative about a commodity or an instrument, then the market turns bearish, the price weakens. If it's positive news, positive sentiments, then the market turns bullish. What is an FX broker? So an FX broker could be someone who offers out or provides your trading platform. In some cases, the broker will trade on your behalf. But when I was trading, I didn't like actually giving my money to a broker when I could understand the market myself and trade for myself. Because a broker could be wrong as well. The idea behind trading is not to never be wrong. Rather, it's about ensuring that your profitable trades exceed your losing trades. That's why we have named this course Forex Trading as a business. Because businesses experience profitable trading periods and they also experience losses. That's why you have a profit and loss statement. A financial statement referred to as a profit and loss statement. What is a bid? That is the buyer's offering price, and the ask is the seller's quoted price. Now let's go back to our analogy of the post office, taking your money to a post office if you're going on holiday to try and exchange your currency for another currency. So the buyer's offering price, if you're going to the US from the UK, your offering price may be $100. So you're taking £100 rather. You're taking £100 to the post office to exchange for dollars. Now the seller's quoted price, that is the post office quoted price, might be $1.30 for your £1. So if your offering price, for example, is £100, then the quoted price will be $130. So the bid is the buyer's offering price, the ask is the seller's quoted price. And the spread is the difference between the asking and the selling price. So that is like a commission that you pay for each trade, essentially. And we'll see that in action when we actually take a trade. What is your pips? So if you watch Bloomberg or Reuters, you'll note that they will say that they'll say things like the Ftse 100 has increased by 100 points today, or it's lost 100 points today. For retail traders, we often refer to the phrase pips instead of points. But a point move is a digital sum of points or numbers, incremental numbers, by which a price increases. So if a price increases from, let's say that you're looking to exchange £1 to, £1 to $1.30. That is the quoted price. You could go back tomorrow and they say it's actually $1.31, and that is 1 point move essentially. 31 cents. So it's moved from 30 cents to 31 cents. That is 1 point move or 1 pip move. We'll be taking a look at our trade lots and our size and our volume. They mean the same thing. Your lots, your size, your volume. Your lot size, your volume mean essentially the same thing. We'll be taking a look at that when we take a tour of Metatrader. But that is how much you're staking on each trade per point move or per pips move. So you could be placing a trade where you're saying you're staking 10 cents per pip move, which is our recommended lot size when you first start trading with $100. So you could say that you're staking 10 cents per pip move, which would mean that if the trade is going in your direction, it's adding 10 cents per pip move. But if the trade is going against you, it's deducting 10 cents per pip move as well. Whereas if you choose $1 per pip move, the same applies. So if the trade is going for you and you're buying, if the price of the instrument is going up, then your equity will be increasing by $1 per pip move or per point move. But if the trade is going against you, you're buying and the price is going down, then your equity will be decreasing or reducing by $1 per pip move. So your trade and lot size or volume is very essential. And we always recommend that you calculate each trade before placing that trade. You calculate each trade. We'll be taking a look at the candlesticks, the bars, the lines, although many retail traders prefer to view candlesticks because they are more visible and they're clearer on our charts than the bars or the line charts. But we'll take a look at those. We've talked about the support and resistance, and I'll be stressing the importance of that as we continue on this course. What is a margin call? Well, we hope that you'll never experience a margin call, but in layman's terms, that's what we experience when we haven't calculated our trade and we haven't used a stop loss. So a trade is going against us. We haven't used a stop loss. So we haven't been stopped out of that trade. And our equity has reduced to a point where it's no longer viable for that trade to remain open, in which case the broker will automatically close that trade on your trading platform. That's what's referred to as a margin call, where we failed to use a stop loss and our losing trade, the deficit has widened to an extent that we haven't got sufficient funds in our account to continue to trade. So that's a margin call. So we don't want any margin calls. Trade execution is simply where we buy or we sell. Our chart is our visual screen where we can conduct our analysis before we place a trade. Indicators, we won't be talking too much about indicators because I simply do not use indicators, or when I was trading, I didn't use indicators because I prefer to view a clear screen. There are other reasons why I didn't use indicators, but we'll talk about those when we actually touch on that subject later on. So, commodities and futures. Commodities include that can be traded coffee, sugar, cocoa, wheat, oil, gas, gold, silver, copper, and many more can be traded on the spot market. Then we've got futures such as the S&P 500, which is a list of the top 500 companies in the US. So you trade the S&P 500 as a single futures on the spot market. So you're not trading each individual company, although you could also trade those, some individual companies actually that are listed on the stock exchange can be traded, such as Amazon, AA, Facebook. But the S&P 500 is just the 500 top companies in the US being traded as a single futures on the spot market on your Metatrader. So we'll take a look at one of those when we actually start trading. Then we've got the Ftse 100, which is the capitalization weighted index of the top 100 companies in the UK listed on the LSE, London Stock Exchange, including foreign-owned companies. So again, you will have organizations such as Amazon, AA, Facebook in those top 100 companies in the UK, simply because this includes foreign-owned companies. Ftse 250, that is the 101st to the 350th largest companies listed on the LSE, on the London Stock Exchange again. And we have promotions and demotions to and from this index quarterly. And then we've got the Euro Stocks 50, which is the top 50 European companies. So again, we can trade Ftse 250, Ftse 100, S&P 500, Euro Stocks 50 on the Forex market, on the spot market, on the foreign exchange market. So what is the USDX? That is the spot rate of the US dollar against a variety of currencies. That is how much is $1 worth at a particular point in time against the average rate of other major currencies, such as the euro, the pound, the Japanese yen. How much is the US dollar worth against the average rate of all these major trade currencies? So the US dollar index is an indication of how much the US dollar is worth against a variety of currencies. Then we've got the GBP sterling index, which isn't as popular as the US dollar index when we talk about trading on the Forex market. Then we've got the Euro currency index as well. But all of these indexes can be traded on your trading platform, on the spot market or the Forex market. Bitcoin can also be traded, Litecoin, Ripple, Ethereum, all of these digital forms of payments can also be traded. But Bitcoin, whilst it is a digital form of payment, I've emphasized here, because I'm in the business of cyber crime and this battle against cyber crime, I'm clear here that I've stated clearly here that it's also used amongst the underworld to hide transactions. And when we talk about, at the latter end of this workshop, we'll talk about the fact that brokers are required to conduct their due diligence before onboarding traders for demo platforms and essentially for live trading platforms, to ensure that we're not seeking to use their trading platforms to launder criminal funds. So they are required to conduct their due diligence with regards to knowing their customer, understanding who their customer is, which is why a broker will seek to make contact with anyone who registers on their platform, just to make sure that they are not onboarding a criminal, essentially. So what features exist on Metatrader? Remember, I've stated that Metatrader is not the only trading platform, because other firms have their own proprietary trading platform out there. So how do we install Metatrader? Well, we visit a broker that offers the meta trading platform, such as FX Pro, AvaTrade, ETX, Admiral, or FXCM in the UK, amongst others. And I've been made aware that in the US, they're only clients are only allowed to download MetaTrader from a few from a few brokers, such as Oanda. There are more, but again, if you're viewing this video from the US, then you need to conduct your own research as to where you can download Metatrader from if this is the platform that you want to use to trade. But we need to make sure that we only select a broker after we've conducted our due diligence. And we'll talk about that. But for the purpose of this workshop, we're using Admiral simply because this offers a wider variety of instruments to trade, including Bitcoin, but essentially it also offers us the opportunity to conduct micro trading. Not all brokers allow us to trade using 10 cents per pip move. Most brokers will insist on us trading $1 per pip move as a minimum. And that means that you have to fund your account with a greater amount of money, which we don't recommend. You have to fund your account, and then you have to trade a minimum $1 per pip move, which is great, some may say. But the issue I have with that is simply that if you fund your account with $500 and you trade and you're a newbie, yes, you may end up making quick profit, but you're more likely than not to lose that account quickly. So choose a broker that offers you the opportunity to trade micro lots, that is 10 cents per point move or per pip move, until you're really comfortable, until you've practiced your strategy, until you've practiced the discipline that is needed to trade. So it's so important that we fund our account with $100 and then we trade this and grow this, compound this account. If we fund with much more, then we just have this sense of overconfidence and we end up with that dreaded margin call. So $100. Don't accept the common stated view from brokers and professional traders alike that the minimum that you can use to start a trading account is $1,000. That is just a sales pitch. Rather, start with $100 and hone your trade using a micro account. Hone your trade, practice and practice and practice. Build up the account. If you start with $100 account and you're making 10 and you're trading 10 cents per pip move and you're making 20 pips a day, which is easy to make, 20 pips a day, that means you're making $2 a day at 10 cents per pip move. You're making $2 a day. If there are 23 trading days in a month, excluding weekends, 23 trading days in a month, by the end of that month, from $100, your account has increased to $146, which is a 46% increase. And there is no savings account that you can invest your money in or put your savings in today that will offer you a 46% increase in a month. So we recommend you trade like that for 3 months, practicing 10 cents per pip move, making 20 pips. By the end of the 3 months, if you've made $46 a month, in addition to your original $100, you would have grown your account to around $240 in 3 months. You can then start trading 20 cents per pip move, consistently making those 20 pips a night or per day, and you're now making $4 per day, because you're still in practice mode here. You're making $4 a day. At the end of the month, you've made $80 a month, or nearly $90 a month. Over 3 months, you're now adding $270 to your $140 account. And then you can increase your lot size again. So you're simply compounding and building up this micro account, developing your strategy and developing your discipline, which is one of the most essential traits that you will need to develop before you can become a successful trader. And so whilst we can train you in how to trade the Forex markets, how to become a good fundamental or technical trader, we can't train anyone in how to become a disciplined trader. So let's take a look at what we'll see on Metatrader. So if we go to the view and then market watch window, we will see different symbols here. So US dollar Swiss franc, US dollar CHF, GBP USD, which is the GBP against the pound. We'll see the US dollar Japanese yen, US dollar Swiss franc here, New Zealand dollar, US dollar, various instruments. And all we need to do, if we wanted to actually view another instrument, let's say we wanted to view a chart of another instrument, is to right click on here to show all symbols, and then we can say view chart, and we'll see that later on. Then we've got the navigator window, which shows us our accounts, our demo accounts that we've got. It shows us any live accounts, if we had any live accounts. It will show us indicators if we want to use indicators, expert advisors as well, custom indicators, and scripts. We'll take a tour of Metatrader in a moment. We've also got our terminal here where we can see our trade, any open trades. We can see our account history, which is any trades that we've made, whether they've brought us a profit or a loss. Here we can see our alerts, any alerts that we've configured, an alarm to notify us when a price hits a certain support or resistance. Then any emails that come through, any notifications that come through from the broker will appear in our mailbox, and a journal will appear here at the bottom of the screen. We have a journal for any trades, for example, that we have closed without the trades having activated, any logins onto the system. So all of that is here within our Metatrader. What other things can we see on Metatrader before we actually switch to the platform? Well, we've got the main menu, which provides access to the program menu and settings. We've got file, view, insert, charts, tools, Windows help. We've got our toolbars, provides a quick access to program features and settings. We've got the market watch window, provides real-time quotes for the instruments to be traded, which we just saw on the previous slide there. Market watch window. Then we've also got the navigator window, which we also saw previously, the terminal window, which we also discussed just there. Then on our Metatrader, we've also got the tools options window. So we go to tools on our main toolbar, and then we have the options window, which allows us to configure default settings on Metatrader. So where it says symbol by default, we can actually configure the last symbol that we purchased as a default. So let's say the symbol that we last purchased was GBP USD. We could say that that is the symbol that should always show up when we go and press buy. And then if we want to select something different, we then change that option. If we want to select oil, we want to select gold, we then change it. But by default, we can say last used, or we can say a default instrument or default symbol should appear when we select buy. Size by default. Now, this is where I mentioned that this is referred to as size or volume or lot size. So default here on this screenshot is 0.05, where we're saying by default, when we go to place a new trade, the trade should open up at 0.05 lots, which is 0.50 cents per pip move. That is the size by default here. If we want to trade 0.10, if we change that to 0.10, what we're saying is that the size by default, whenever we go to place a new trade, should be $1 per pip move. If we change that to 0.01, then the size by default will be 10 cents per pip move. So this is just configuring defaults. But when we go to place a new trade, we can, of course, select what we want, which may be different to the default. Deviation by default, during a volatile market, a pending order may not set in, it may not actually be activated. So if we've placed a pending order at 1.300 buy GBP USD, a pending buy order at 1.300, for example, if we say that pending order, we've left our laptop, closed our laptop, we've walked away because it's a pending order. If the market is volatile, the price may simply reach 1.3005 and then reverse. But if we say deviation by default 5 pips, when the price reaches 1.3005, it will pick up our order, because we've said deviation by default 5 pips. One-click trading, I'll show us that within Metatrader, but again, I don't like using that. I don't select a deviation by default, and I also don't like using their one-click trading, simply because that provides us with a little icon on our Metatrader where we can automatically select a trade. I've got 2 issues with that. Number one, you can accidentally press on that icon when you're doing when you're just moving around your trade. You can accidentally press buy or sell, and that's it. And number 2, and most importantly, I like to plan each trade. Whereas with that button there, that one-click trading there may be a temptation to simply see the price racing up on an instrument and you quickly select to buy without an understanding of what is driving that price movement. So choosing a broker, how do we avoid scam brokers? Well, first of all, we need to identify, as I said earlier, what amount of funds is required to start an account. Do they allow micro trading? If they allow micro trading, then they'll allow you to invest far less than $500. So they may allow $100. I've even read of some that have offered accounts for less than that. So amount of funds required to start an account, that's very important when we're considering a broker. We need to take a look at the margin and the leverage allowed. We need to take a look at the reputation of the company. But most essentially, we need to make sure that the company is regulated in our home country. So in the UK, we have got the FCA, the Financial Conduct Authority. And so they regulate companies, and in the event of a default by those companies, then the FSCS will guarantee up to 85K of a trader's deposit with a broker. Same as if you have savings in a bank, they will guarantee that amount and refund it to you if the bank goes bust. If you're ever fortunate enough to have 85K in your account, then please withdraw that. Don't leave that amount of money in your account anyway. Now, there are some brokers who fraudulently obtain money from unsuspecting traders, and they obtain that money from you, then they let you trade that money up. They let you trade your equity up. Let's say you invest £500 from the onset in your account, if it's not a micro trading account, or even $100. You invest that, you trade it up to $1,000 over a period of time, and then the broker just disappears. So that's why we say you only register with regulated brokers. So you check the name of your broker, and then you go and search the FCA register to ensure that the broker is actually registered with them. And you also need to know how responsive is the customer services team of your broker. You'll also be looking at the spreads for the currencies you'll be trading, as that determines how much you pay per trade. And you also need to check for any rollover fees for positions held overnight. Does the trading platform provide a micro demo and live account for you to practice on, as I've reiterated there? You need to also look at any commodities, currencies, and cryptocurrencies included, as to whether these are offered if you want to trade in Bitcoin, for example, as some will offer Bitcoin and some others don't. You need to take a look at how easy it is to deposit funds and withdraw funds, and also check review websites such as dailyforex.com, Forex Brokers Reviews, Forex Peace Army, and forexfrauds.com. Check the Forex broker reviews on each of these sites to make sure that your broker that you're thinking of going with is not fraudulent. So here are key considerations. We buy low at a major support always. When we're placing a pending order, which is a buy limit, as an example, pending order buy limit, that means we're saying that we want to buy from below the current price at a support. A buy stop order means that we're buying from above the current price after we've breached a resistance. Sell, we always sell high, always, from a resistance. Sell limit is when we're placing a pending order to sell from above the current price at a resistance. So if we've observed our charts and we note that Gold, for example, has always fallen when it's hit to 2000, but 2000.10 or something in price per kilo. Then we can place a pending sell limit order from the current price where we are at now, because we know that when the price reaches 2000, it's going to drop based on historical price action. Sell stop is where we're selling from below the current price after we've breached a major support based on historical price action again. Volume is the selected lot size, as I said, for each trade. A stop loss, essential. That is one of your key instruments available to limit your loss on each trade and to preserve your equity. A stop loss enables you to return to trade another day. Take profit is a set point at which you want an individual trade to close when it's in profit. So again, if you believe the euro will strengthen against the US dollar, you'll want to buy the euro US dollar now and close the trade in profit. That is, take profit at a higher price or at a resistance. But we don't base our belief on a hunch or a guess or a bet. Rather, we conduct thorough analysis, which will show you how to do either technical analysis or fundamental analysis. So again, when we're trading falling prices, if we believe that cable or the sterling will weaken against the dollar, we'll want to sell the GBP USD and close the trade in profit or take profit at a lower price or at a support. So when we're placing an order within Metatrader 4, we can either press F9 on our keyboard or select Tools and New Order, or we simply right-click on the chart and select Trade in a New Order. Or on the toolbar, we've got New Order. There's multiple ways, but here are some of the ways in which we can place a new order. And again, if a currency pair or instrument we would like to trade isn't displaying in the standard drop-down box, such as oil, then we right-click on the Market Watch window, select Show All, and then we select Brent or crude oil. We'll have to search for it. And once we've found Brent or crude oil within the Market Watch window, we then right-click on Brent or crude oil and select Chart window to display the chart of the instrument we would like to trade. So let's now place a practice trade. So before we place a trade, let's actually just start a tour again of Metatrader, just to make sure we understand what we've just viewed within the slides. So if we take a look at Metatrader itself, if we click on File, we've got the option of opening a new chart. And we've got a selection of all the different charts that we can open here. We can see the Forex majors, Forex minors. We've got spot metals. Because this is a demo platform, we've only got gold here, but under a full trading platform, we would see silver and copper as well under the metals category. We've got cash indices such as the DAX 30, Dow Jones Index 30, ASX 200, Ftse 100, MDAX 50, TechDAX 30. We've also got NASDAQ. We've got S&P 500, NASDAQ 100. We've also got the minor indices here. We've also got other indices. We've got other cash indices here. Spot energies such as Brent and crude oil. We've got CFDs, that is shares of some of the major companies in the US. For example, we've got Google, Amazon, Apple, AA, we've got Facebook. This is because we're limited to the stocks and shares available on the demo platform. We've also got cryptocurrency, including Bitcoin, we've got Ethereum, we've got Ripple, we've also got Litecoin here. So if we go to the file menu there, we can see that there's also another place that we can view all those instruments, but we'll take a look at that under the view menu. So when we go to file, we can open a new chart. That way we can also view a chart offline where the price actually isn't moving. So where we view a photograph essentially of a chart. We can open any deleted charts. We can create a folder or a default profile of a chart where we've labeled up the chart with trend lines and navigators or indicators, things like that. And then we can subsequently save that as a profile. When we reopen that profile, it will show us the charts that we've saved with all the indicators and things like that on it, such as this profile that I've got here. I believe this is a default profile because I don't work with indicators and things like that on my chart or the one-click trade window on. So I'll just go back and I'll just open up a new chart of the GBP USD without all those indicators there. Now, so we go to file, new chart, we open up a new chart, we can say open offline profiles, we can save as a picture, we can save this chart as a picture to include in a document or to save online. We can also open an account from this window. So when we want to reopen a new demo account, if we click on open demo account, file new account there, and we go to next, so the server that we'd be choosing is the demo server of whichever broker we're registered with for our demo platform. We choose the demo server, then we go to next, and then we say new demo account, and this will take us to the broker's website where we log in once more, and that will provide us with an account, a new account number and a new password to reopen a demo account. So we can open as many demo accounts as we want. The most important thing there is that, again, we do not feel pressured to trade on a live account until we're ready, if ever. So we open a new demo account, or if we're going to open a live account, once we're comfortable with trading, if we want to start trading, then again, we would just go to new account there, and we would just go through the same process. So we can log into our demo accounts. If we've got multiple demo accounts, we can log into those from here, from this window, file, log into trade account, and you just enter the demo details that you've been provided with by the broker. You can log into an online trader. You can log into the Metatrader trading community if you want to, if you create an account there. And then you could also print information off of your Metatrader, print your chart view, for example. What else can we see under the view window now? Well, different languages, but we're sticking with English. We've got different toolbars. So we've got the standard toolbar, we've got the charts toolbar, which we'll see when we move along this line, which provides us with different charts. We've got line studies which we can use to draw lines. And then we've also got the time frames, and we can see some of the time frames here, which we'll talk about. We've got the status bar, which is at the bottom of our chart. So if we choose to turn that off, then we can turn that off. We've got the charts bar. So if we go here, we've got the bar chart, candlesticks, line chart. That's also available on here behind this, behind these documents here. So multiple options there. Then we've got view market watch. Now let's take a look at what's available under market watch. If we say view market watch, that will show us this window. So we've got this window, and that shows us the same symbols that we saw earlier. We've got gold here, we've got different commodities such as Ftse 100, we've got different indices, we've got S&P 500 somewhere here. We've also got Bitcoin and all those cryptocurrencies that we spoke about earlier. We've got Brent oil, crude oil. So you can view all of those within the market window, market watch window, if you prefer to work with that window open. So you might prefer to work and trade with this window open. What else can we view? We can also view our data window. So this will show us if we select a candlestick or we select a bar, and I'm going to change this chart in a moment, but if we select a candlestick or a bar on our chart, it will show us the details of that bar, including the date of that bar, the time the bar opened, the opening price, the highest price, the lowest price, the closing price, and the volume, which is the number of traders on this demo platform within that time frame of that bar. So that is our data window. Let's also view our navigator. Here we've got the different demo accounts I have open here that I have with this broker, different demo accounts that I've opened for the purpose of this workshop. We can also view indicators here, and we'll talk briefly about indicators, but we won't be showing us how to use these indicators because I simply don't use indicators, and that's something that you can learn beyond this introduction to Forex trading as a business. Also, expert advisors and scripts, the same applies here. We don't necessarily train on these, we just mention that they exist. So under view, we can also view our terminal. So what's available within our terminal window? That shows us any trades we might have open, but there's no trades open here. That shows us our exposure. If we have trades open, it shows us what percentage is long, what percentage is short. And then we've got our account history of any trades that have been made on here you can see that this is a demo platform, but if this were a live platform, then it would show us any deposits that we have made with regards to funds. Then it will show us a history of all our orders. Buy order here, a sell order here, and also we've got our orders that we may have, our pending orders that we may have placed, which have either expired or we've deleted them. So pending orders which haven't been triggered, which haven't been activated, but may have expired because we've configured a time limit on these orders, or we may have actually manually deleted these. Any news about Forex trading comes into here, it comes into your news box here. Then you've got alerts. So we could create an alert. So let me just create an alert for And before I do that, let's switch to the GBP USD charts. I want to switch to one that doesn't have all these indicators open. So I'll close this one and I'll close this one. So, and I close that by right-clicking on it, right-clicking on the window there, right-clicking, and then simply saying close. So now let me go and open, or I'll keep the navigator window off, and on the chart window, we've got the option of selecting. So by default, it opens with what we refer to as a bar chart. But on that same window, we've also got the option to change this to a line chart. And I'll zoom in for us to see this. Line chart. Or we could also change to candlesticks here. And this is the view that is preferred by most retail traders. That is traders that trade Forex from the comfort of their own homes, like you and I, where we're not professional traders. Now, if we take a look at this chart here, we've got each candlestick currently representing the price action of 1 hour. These are hourly candlesticks. Why am I saying this? Because up here on the timeline bar, we've selected 1 hour. If we switch to this, each candlestick M1 represents a minute. Then we've got 5 minutes. Each candlestick here represents 5 minutes worth of price action. We've got 15 minutes. Each represents 15 minutes, 30 minutes, 1 hour, 4 hours. So each candlestick here represents 4 hours worth of price action. We've got daily candlesticks here now. Then we've got weekly. Then we've got monthly candlesticks. So here, if we look at alerts, now I could say that I would like to place an alert, just like a calendar alert, that would sound out once the price is lower than XYZ amount. So that we can test this, I'm going to place an alert for when the price is lower than 1.3030 on cable or on GBP USD. It's currently at 1.30278. So hopefully this alert should be triggered as soon as I create it. So if we take a look at that, enable sound, what symbol are we talking about here? We're talking about the GBP USD, and we're saying that when the ask is less than 1.3030, which it currently is, it should sound an alert. So why would we need an alert? Just in case we've done our analysis and we believe that when the price reaches 1.3030, there may be an opportunity to buy the GBP USD. But if we're not certain or if we're not too confident in our analysis, we could place an alert there so that we're simply saying when it reaches that value or less than that value, it should sound an alert so that we can come and observe what is going on in the market, both from a fundamental perspective, from watching Bloomberg, and also from a technical perspective, from viewing the candlesticks on the chart at the time. So let's test this. And we may have heard a beep there. So let's just put that in. And I've said, okay, so here's the alert, and it's immediately sounding simply because the price has reached the threshold that I set there. Ask is less than 1.3030. So let's now delete this. So we've also got a mailbox, we've got market. So mailbox, this is where the broker sends us emails, essentially. such as Hong Kong and Austria public holiday. So here's the market timeline or timetable for the Hong Kong and Austria public holiday market. Now we've also got signals. Again, I don't buy signals. And the reason why I don't buy signals is simply because the traders who sell signals may well say, okay, that we have increased our account by 500% over a timeline of a year, and we have made $1 million, for example. But I tend to view that if I can't make that $1 million myself, then I don't see why I should entrust another trader out there to make that $1 million for me. And the fact remains that other traders get it wrong. Professional traders get it wrong. Even traders at Goldman Sachs sometimes get it wrong. Professional traders who have been trading all their life. And the only thing that really stops them from losing all of the bank's equity is simply their stop losses. So here are signals from some traders, I believe, and this didn't used to be there actually about by 2017 when I stopped trading 2016, 2017. This didn't used to be there, but it's now available. Signals from other traders where they're saying, this is what I'm actually doing. This is how I'm trading. This is the trade that I'm about to take. Another reason why it's not advisable to obtain signals is because the signal providers don't know how much equity you have in your account. As far as they're concerned, even if it's a free signal, you may not have as much as they have in their account available to trade with. If you're trading on $100 account and they're suggesting that you buy cable from 1.300, for example, you may not have enough equity to place that trade. So it's best to actually learn this thing ourselves and then conduct our own analysis and take our own risks. Then we've got articles, we've got code base, we've got experts, we've got our journal. Our journal simply says, provides information as to when we logged on to our Metatrader and when we logged off and things like that. Now, so view terminal. So I've turned on the terminal, and most traders will keep their trade window open all the time because that simply shows them what trades are open at that point in time, or what limit orders, what pending orders they have here. And I'll actually delete these pending orders because I'd like to actually take us through creating those at some point this evening. So let me just delete this order and delete. So I'm right clicking on a pending order and I'm just saying modify or delete, and I'm saying delete. And I'll do that with the third one as well, and I'll delete that, and we'll take a new order shortly. So we've got view and we've viewed the terminal. We can also test our strategy. We can run some chats within Metatrader, but I'm not going to go through that. Now let's go here. What can we insert? We can insert some of these indicators, which I'll discuss another evening on this training, discuss rather briefly some of them. We can insert lines, but all of these are actually available to us here on the line bar to also insert. So we can insert lines, we can insert a Gann line, we can insert our Fibonacci lines here and just show the retracement, show what Fibonacci was referring to in terms of percentages of retracement, which we'll discuss later. We can insert shapes and arrows just to remind ourselves or prompt ourselves as to where the support and resistance might be. We can insert a price label on each candlestick as well. Then we've got all of these, which we won't go through. Now let's go to our charts window again. We've got the bar chart, candlesticks, and line chart. And we've also got other things that we can insert, volumes, which shows us the volumes, the number of individuals that have taken a trade within a time frame on this demo platform. Now, we've also got, we've gone through our charts, we've got zoom out, we've got properties. Now let's go to tools and options here. Now, tools, options, this is the most important feature of the tools window. So we've got options. Let's go to tools and options again. Okay, selected that correctly. Once we've gone to tools and options, the main window we need to come into here is the trade window. Here we've got symbol by default. So what symbol do we want to be made available to us by default each time we select new order? Symbol by default will go for the GBP USD, but you can choose any symbol there. You can actually say that each time you click on new order, the symbol you want available to you by default is the Euro USD. Or you could say the US dollar, Japanese yen. But we'll see, okay, we'll go for US dollar, Japanese yen, just so that we can see what we're doing here. But again, you can select an alternative symbol once you click on new order, but this is just what will show up initially when you place that order, when you click on new order. We've also got size by default. What is the lot size or the volume that you want to be displayed in that new order window by default? Again, 0.01 means that you're placing a trade at 10 cents per pip move. 0.10 means you're placing a trade at $1 per pip move. And 1.00 means you're placing a trade at $10 per pip move. And that means that when you're selecting 5.00, you're placing a trade at $50 per pip move. Now, the good thing is that if you've got a $100 account, you can't place a trade at $10 per pip move, for example. The system simply won't allow you to do that because you don't have enough leverage to place a trade at $10 per pip move. But my advice remains that even if you have a $1,000 account, your best bet of becoming a successful trader is to start small. If you've got a $1,000 account, trade using $1 per pip move until you've built up your equity. But if you've got a $100 account, which is our advised amount to use to practice on your demo repeatedly and when you also go live. If you've got a $100 account, just repeatedly practice using 10 cents per pip move. So you're not risking too much of your equity. 10 cents per pip move. Practice consistently making profit with that. So we'll leave the default at 0.01, which is 10 cents per pip move. Deviation by default, that is simply saying if in a volatile market, the price doesn't get to your pending order point, that it should activate your pending order if it gets to within 5 pips of your order per se, or within 4 pips of your order. If the price gets to within 4 pips of your order, the system should activate that that pending order. One-click trading, I don't necessarily like having that on, simply because if we select that one-click trading, it sometimes gets in the way. You want to go and actually view something or so, and you could accidentally click on buy or sell without having done your analysis of the market. So that is one-click trading, which we can turn on or turn off. So I'll turn that off. Now let's take a look at our window. We can actually tile our windows, or we can cascade them. So if you've got 4 windows open, we can just cascade them and they will appear in the here. They will appear here. Let's actually just try something for a second. Let's open a new new chart again. We'll open another GBP USD and another GBP USD and another GBP USD. So we've got 4 of those open, but we could actually open another another commodity or instrument there. Now I'll quickly change them to our candlesticks. Change this one as well. Remember, I said by default that it opens up the bar chart. So I change it to candlesticks, and I change this one to candlesticks as well. And then I zoom in so that we've got a nice view of that. Now, what I've done there is, so I've got monthly, I've got GBP USD hourly, daily, and I'll change this to 4 hourly, for example. So each of these candlesticks, if the candlestick is filled with white here, then that means that the price closed lower than the opening price during that period. So on a 4 hourly chart that we're viewing here, this candle is filled in with white. That means that the price closed lower than the opening price. If it's filled with black, that means that the price closed higher than the opening price. These are default colors, but we could right click on the properties of our chart and change our colors within here if we'd like to. So these are the default colorings. If it's white filled in with white, that means that the price of the commodity or the instrument that we're trading or the currency was actually bearish because the price went down rather than up. So if we were selling at that time, we would have made a profit. If we're selling and the price is going downwards, then we make a profit. If we're buying and the price is going upwards, we make a profit. But if we're selling and the price is going up, the only thing that will preserve our equity is if we have a stop loss in the right place, a calculated stop loss. So I've got 4 charts open of different periods here. So what I'll now do is I'll view these and I'll just go under window. So I'll go to window and I'll tile those windows, and it just shows me, and let me just remove the terminal. I'll remove the terminal and then I'll just increase the size of these windows so that I can view the price action of the GBP USD or cable within different time frames to help me see exactly what's going on with the same currency. Or I could choose different currencies, but I'll just stick with these. So this is GBP USD monthly, GBP USD daily, GBP USD 4 hourly, and then hourly. So we can view whatever we want to using the window menu. So I'll keep that there. So we've got, so I'm on the monthly now. So now let's take a look. We've also got help files here, different help topics that we can seek help on, including how to use the indicators if we'd like to. Then we've got tools, we've got History Center. This is just a database of historical price action on all the symbols or the instruments that are being traded on our Metatrader platform. But we can also view the same historical price action by clicking on our different candlesticks. Now let's take a look here. We'll go and place a new order. We'll view how to place a new order. Remember we said that the default symbol that we'd like to see each time we click on new order is the Japanese yen, US dollar Japanese yen, and that's what is here now. And we can change that, as I said earlier, and select GBP USD and the volume. Again, we can say 10 cents per pip move or per point move. We can say 50 cents per point move, or we can type in 0.10, which will be $1 per point move. So if we place a buy order now and the price is going up, then that would be giving us $1 per point move. If the price is going against us, that will be reducing our equity by $1 per point move. But it won't reduce our balance until the trade is either stopped out automatically or we close it manually ourselves. If the trade is going in our direction, it will increase our, let me just open the terminal. So if a trade is going in our direction, it would increase our equity by 10 cents per pip move. If that's the volume that we're trading, it will increase the equity, but it won't increase the balance until we have closed the trade. Once we've closed the trade, it then saves that gain or loss against our balance. It adds to or deducts that from our balance once the trade is closed. So if the trade is going against us or for us, our equity is what increases or reduces, and our balance remains the same until we close the trade, until we click on close the trade. Now let's take a look at placing a pending order. So we've got GBP USD here. So we can say new order, and let's go to GBP USD, the pound against the dollar. And instead of going for market execution, we say pending order. We can place a buy limit order where we're saying when the price action reaches a support based on historical price action and based on the fundamentals that we're hearing about the currency at the moment. Let's say there's an election in the US. So we know that the price, any currency traded against the US dollar, will move in some direction next week when the election is held. We've also got Brexit. So again, there will be some market movements next week. So we're placing a buy limit order at a support, saying that when the price reaches this support, the market should automatically place an order for us. So I'm going to place a pending buy limit order at 1.1390, let's say, which is just above this candlestick support where the price went down to the price of the GBP USD went down as low as 1.1 1.1 1.14096. I can only marginally see that at the bottom here at in the status window when I hover my mouse on that, and that's because I've got these windows open. So let's actually place this at 1.1500, for example. So I'm placing a pending order there, and I'm saying that it should buy when the system should buy the pound against the dollar when the price reaches that low. And I'd also like to place in a stop loss, saying that if it goes as low as 1.1, 1.1300, for example, then it should stop me out. Now that is 200 pips, which is a lot. That is a lot. That is 200 pips. But because I am placing a trade at 10 cents per pip move, what I'm saying there is that if the market goes against me by 200 pips rather than starts rising from this price of 1.1500, if the market goes down as low as 1.13,000, the market should stop me out at 10 cents per pip move, which is 200 pips times 10 cents. So that is $20 basically. So I'm willing to risk $20 with the expectation that if the market goes down this low to 1.1500, for example, and then it goes down as far as 1.1400, my belief based on historical price action is that the price will reverse and return to at least 1.3. So let's say it reverses and returns to where we are now, 1.3 thousand. We'll say 1.3 thousand. So that is 1.3 thousand. So that is effectively 1,500 pips I'm expecting it to rise by. And if the market rises by 1,500 pips at 10 cents per pip move, then that says that I'm willing to risk $20 for a profit, a potential profit of $150. So this is what we refer to when we say calculate every single trade. If the market goes against me by 200 pips, I believe that the market will rise from there. If it goes below this support here, I believe the market will rise from there. But if it doesn't, it should stop me out at minus 20 pips, which is minus $20, which is 200 pips. But if it doesn't reach this 1.13 thousand, then I believe that the market is going to reverse and it's going to come from that 1,000, however low it goes down, I believe it's going to come back up to 1.3 thousand, which is where we are now, which is a rise of 1,500 pips at 10 cents per pip move, which would give me $150. So I'm placing this pending order now. However, before I place the pending order, I'll also set an expiry date because I know that next week, Tuesday, is going to be rather volatile due to the US elections. So I may want to set an expiry date for I'll set it for Friday. So this Friday is the 30th of October. 30th, and I'll set it for something like before the market closes. I'll set it for something like 2000 hours so that I can then conduct further analysis on Monday, the night before the election. But I don't want to leave a pending order in place in case the market moves beyond there, because the market will be volatile next week, Tuesday. So that is one pending order. I could also place a buy stop order. What is a buy stop order? That's where I'm seeking to place a buy order above a historical resistance with the view, after having conducted my analysis, that when the market breaches that resistance, it's going to go up. It's likely to go up to the next resistance. So when I place a pending buy stop order, all I'm saying is the price is currently at 1.3029, and I know that a historical resistance is 1.34725 from my charts here. That's a resistance there, where the price reached there in September 2020. And if we also look at November 2019, we reached the same resistance before we fell all the way back down there. So if I'm now saying that once the price reaches that resistance again, I believe we could go as far as 1.42675 or 1.39 something, then I could place a buy stop there saying, okay, that the system should place an order, an automatic order for me. Once we breach that 1.34725, I'll go for 1.3482 or something. So 1.3482, 34827, let's just put in a 7 back there. And I'm saying take profit when we get to 1.33973 or something. No, let's go for 927. Okay, so I'm saying take profit at 1.3927 there. So, okay, and then I now need to place a stop loss there as well, just in case the price returns, instead of going up, that it starts coming down. So I could place a stop loss of, say, something like 50 pips, saying that if the price goes down to 1.38, 1.3877 or so, that it should stop me out, because I believe that it's going to go up, but peradventure the price comes down instead of going up, then I'd rather that it stops me out. So let's place this order, and again, I could set an expiry date of the 30th. And I'll go for 8 p.m. and place. Okay, so buy stop, and I've put an errant stop loss there because it's not happy with something. So I'm saying buy from there. Okay, and so my stop loss clearly needs to be below 1.34827. And so whenever you get an error message when you're trying to place an order, it's either you've put the stop loss in wrong, or if you said buy stop, you may be putting the pricing at a price that's lower than where you are now. So always review without any panic exactly what we've typed here. So I'll go for 1.34827. I can say stop me out at 1.3. 1.3420, let's say 1.3420. It's a very tight stop loss, but let's just, and that's it. So let me just remove this terminal a second so that we can see what I've placed there. So I've said that when the price reaches here, 1.348 something, that it should buy, and it should take profit up here. which is just over 400 pips. But I then put in a very tight stop loss, saying that it should stop me out at minus 50 pips. So I'm willing to risk 50 pips for 400 pips. But that's based on my analysis of all these resistance points and this resistance and this resistance and any supports in place. So that's how we place pending orders. That's how we place new orders. So we've placed some pending orders. We've also placed a potential, well, we haven't placed a new order, but if we wanted to place a new order, an immediate order, we'd simply just go to GBP USD or any instrument, and then we just say buy by market or sell by market. And the spread, the cost of each trade, is simply the difference between the buy price and the sell price times the volume. The difference between the buy price and the sell price, the difference between these two last digits here, and the volume, times the volume. So that is the spread that you pay for each trade. So for each trade you place, you pay a one-off spread. If you're trading at $10 per pip move, your spreads will be times 10. So if you're trading at $1 per pip move, your spread will be times $1. If you're trading at 10 cents per pip move, then your spread will be times 10 cents. So it's a proportionate fee that you pay per trade. And that's why I've been asked the question, should we engage in scalping, where we're just quickly banking any profit we make as newbies to the market? My response to that is no, because when you're scalping, you don't get to place a stop loss, and you could be caught out by a sudden reversal in the market. So if you're scalping and banking 3 pips here, 3 pips there, 5 pips here, 6 pips there, when a market is trending, when the market is quiet and you're banking those pips quietly, if there's sudden fundamental news that is released, the market could turn so rapidly, and you don't have a stop loss in place if you're scalping, because that defeats the purpose of scalping. So you don't have a stop loss in place and you suddenly give up all your profits to the market. So that's one reason why we don't scalp. Another reason why we don't scalp is we remember that for each trades that we're placing, we're paying a spread. So if the market is going to go up by 50 pips and you place an order for 3 pips and you pay a fee for that, you pay a spread for that, and then you see that the market continues to go up, and then you enter in again, you're paying another spread, then you're re-entering again as you notice that this is actually going up a bit more than I thought it might be going up, and you keep paying these spreads. So scalping isn't a strategy for the faint-hearted, and it's definitely not a strategy for newcomers to the market. And it's not a productive strategy anyway, for the reasons that I've just suggested there. But some experienced traders do actually scalp. They adopt that as their own strategy, and they hone their trade in that simple strategy of scalping. So we've taken a look at Metatrader, and I hope that I haven't missed anything out. And so we'll return to conclude the training next week. Thank you for your time.